Roth IRA versus traditional IRA. Which one fits you in 2025? Same $7,000 limit, very different tax outcomes. In 2025, here's how to choose between Roth and traditional with simple, evidence-based rules. Many investors guess Roth versus traditional and leave money on the table. A clear framework based on your tax rate today versus later, plus hard IRS 2025 numbers. We cover contribution and income limits, deduction rules, withdrawal rules, RMDS, a decision tree, and common edge cases. Sections. Section A, quick definitions. Traditional IRA, pre-tax deduction if eligible, growth tax deferred, withdrawals taxed as ordinary income. RMDs start at age 73. Roth IRA, contributions after tax, growth tax-free, qualified withdrawals tax-free, no RMDS for the original owner. 2025 annual IRA limit, $7,000. Catch-up 50 plus, $1,000. Section B, 2025 limits and phase-outs you must know. Roth IRA income phase-outs, 2025. Roth IRA phase-outs, read your filing status row. If your MAGI is below the full contribution threshold, you can contribute the maximum to a Roth IRA. Within the phase-out range, your allowed contribution is reduced proportionally. At or above the no contribution number, you cannot contribute directly to a Roth and should consider a backdoor Roth. For married filing separately, if you lived with your spouse at any time during the year, the phase-out is $0 to $10,000, which effectively blocks direct Roth contributions for most people. Traditional IRA deduction phase-outs, 2025. Traditional IRA deduction. This table doesn't limit whether you can contribute. It determines whether the contribution is deductible. If you are covered by a workplace plan, use the appropriate RAL. Below the range, your traditional IRA contribution is fully deductible. Inside the range, the deduction phases out. Above the range, the contribution is allowed but not deductible, so compare it against a Roth IRA. For married filers, whether you or your spouse is covered changes which row applies. For married filing separately, if you live together during the year, the range is $0 to $10,000. Section C, mechanics that drive the choice. Core lever, marginal tax rate today versus expected in retirement. Traditional wins when the deduction reduces income taxed at a higher rate today than the expected rate later. Roth wins when today's rate is lower or when tax-free flexibility is valuable. Liquidity, Roth contributions, not earnings, can be withdrawn anytime tax and penalty-free. Avoid this unless necessary. 5-year rules. Roth earnings require 59.5 plus 5 tax years since first Roth IRA contribution for qualified, tax-free status. RMDs. Traditional IRAs have RMDs starting at age 73. Roth IRAs have none for the original owner. Section D, decision tree, 2025. Do you expect your marginal tax rate to be higher now than in retirement? Yes, higher now. Traditional IRA if deductible. If deduction is phased out, consider Roth or a backdoor Roth. No, same, or higher later. Roth IRA if eligible. If over Roth income limits, consider backdoor Roth. Then, Need near-term liquidity? Favor Roth for contribution access. Then, want to minimize future RMDs? Favor Roth. Then, state tax. If you're in a low-tax state now and may retire in a higher tax state, favor Roth. Reverse may favor traditional. Section E. Worked examples. Example 1. Single, $120,000, MAGI, 24%, federal bracket. Eligible for full Roth. Today's 24% is likely less than or equal to future. Lean Roth. Example 2. MFJ, $210,000, MAGI. Both covered by plans. 24% bracket trending down to 22% in retirement. Traditional deduction phases out only if MAGI in $126,000 to $146,000. At $210,000, deduction is not allowed. Roth allowed until $236,000. Lean Roth while eligible. If MAG rises above $236,000, use backdoor Roth. Example 3. Single, $85,000 MAGI, covered by plan, 22% bracket with variable income. Deduction phase-out starts at $79,000. If deduction is partial, run the numbers. After tax, Roth versus partially deductible traditional. Often close. Tax diversification may be sensible. Section F. Edge cases and cautions. Backdoor Roth, still allowed in 2025. Triggers pro rata aggregation across all non-Roth IRAs on December 31st. Use a 401k roll-in to avoid. Early withdrawals. Traditional IRA distributions before 59.5 are taxable and may face a 10% additional tax unless an exception applies. Roth earnings withdrawn early are taxable and may face the 10% additional tax. Contributions are always available, tax and penalty-free. State conformity. A few states differ on IRA deductions and Roth treatment. Verify for your state. Employer plan. First, if your 401k offers a match, earn it before funding IRAs. Write down your current marginal bracket and your expected bracket in retirement. Which is higher? Are you under the Roth MAGI limits for 2025? If not, note backdoor Roth in your plan. Do you need access to contributions within 5 years? If yes, Roth flexibility matters. The simplest rule that works. Align account type with tax rate arbitrage. Deduct when rates are higher now. Lock in tax-free growth when rates are lower now or uncertain. Add liquidity and RMD preferences as tiebreakers. Definitions. 2025 limits. Phase-outs. Withdrawal rules. RMDs. And a decision tree. Next actions. Confirm eligibility. Choose Roth or traditional per your tax rate outlook. Fund up to the 2025 limit and set an investment policy. Subscribe for weekly breakdowns and download the free 2025 IRA Choice worksheet in the description.